Morning, everyone. Thanks for coming out so early on a Sunday morning. I guess everyone's excited to hear about silver and everything else our panel here has to talk about. So why don't we jump right to it? My talk is going to be on silver and how we're facing a new investment landscape and how silver is massively mispriced. Before I jump into that, I just published a book about a month ago called The Great Silver Bull. It summarizes or goes into a lot more detail about what I'm going to talk about today and explains in depth the opportunity in silver. It's available on Amazon and in paperback and in Kindle. It's been a bestseller since its release. So the new investment landscape. About a month ago, Paul Tudor Jones, a billionaire hedge fund manager, said he could not think of a worse financial environment for stocks or for bonds, and that in this kind of environment, capital preservation is key. In my view, the single biggest threat to your wealth and your savings is inflation. And I think it's starting to hit home. People are really starting to realize that. If you look at demographics in the US, for example, 2/3 of the population were under 10 years old in 1980, so did not live through or experience inflation in a substantial way and really live with it and understand what it means. So it's easier to understand why so many people are it's not really sinking in for them, and how they're not really realizing that inflation certainly is here now, and it is here to stay and to stay at elevated levels. So it's a threat to your standard of living, to your wealth, and to a comfortable retirement. And these are all reasons to look at some serious alternatives. To just see how quickly we've gotten where we are. When inflation bottomed in early 2020, when the pandemic hit, it was very much near zero. And in 2 years, we went from 0 to 8.6%. And many people, as I say, thought it was all going to go back to normal. Well, I think this, in fact, is the new normal. It really is not transitory. And a recent survey by DataStream tells us that it's the single biggest concern for Americans. 32% say inflation is their single biggest financial concern. If you look at what's been happening with debts, on the federal level, that's one thing else completely, but on a personal level, mortgages are at new highs, car loans are at their fastest growth in years, and student loans are also at new high levels. And inflation, really, the insidious part of it is that it leads to a massive loss of your purchasing power. And yet, inflation is at 8.6%. The Fed's fund rate is only at 1%. And if you, all of the 2-year, the 10-year, and the 30-year treasuries are now all above 3%. So if you look at real rates, what you can earn on, say, a 10-year treasury, and you subtract inflation, you're actually losing 5.6% a year on your money. So we're starting to see this hurt. Mortgage rates have doubled. In the last year, they went from, the 30-year rate went from 2.5 to over 5%. Naturally, that's hurting home sales. We've seen those start to dip. Home renovations are going to hurt as well. People take out loans for that as well often. The related materials and sales of materials for home building and home renovations, related jobs are going to start to hurt as well. And through all of this, since the start of the year, it certainly looks like we're at the start of a new bear market in both stocks and bonds. And yet, bonds are supposed to zig when stocks zag, and that hasn't happened. In 2 months, in the first part of this year, I think it was January and April, we had net drawdowns in both stocks and bonds, and normally that just does not happen. That's a true outlier and a sign that the 40-year bond and bull markets are at their ends. And yet commodities are up 44% if you look at the Deutsche Bank Commodity Index in just the first 5 months of this year. The S&P is down 18%. 20-year treasuries are down 19%. Bonds are supposed to be safe. 20-year treasuries are down 19%, and commodities, as I say, are up 44%. So how did we get here? Well, in the last 20 years, the global money supply is up by 5 times. There are 5 times more currency units sloshing around in the world today than there were just 20 years ago. The national debt in the U.S. is over $30 trillion. The Spending is over 6 trillion, and yet revenues are 4 trillion. And so that means that the US government is spending 50% more than its annual revenues. In 1960, the debt to GDP ratio was 53%, and it was actually falling through the 1970s and dropped to 35% by 1980. Today we're at 130% in the debt to GDP ratio. So the debt to the economic output is nearly 4 times what it was in 1980. And this is a chart that shows you how that acted in the 1970s. It was actually falling. And that with much, much lower debts to economic output versus economic output, that gave the central bank a lot of firepower to be able to raise rates, a lot of guts too, something we don't have today, but a lot of firepower to be able to raise rates and crush inflation, even if it was for a short amount of time, having to raise rates so dramatically to 20%. We just don't have that option today. Debts are just much too high, and everybody knows it, mostly everybody. If you look at the Federal Reserve's total assets in 2008, they were at $1 trillion. Reaction to the global financial crisis in 2008, 2009, that doubled to $2 trillion and just kept growing. By the end of 2018, we were north of $4 trillion, and it leveled off and dropped off slightly. But when the pandemic hit, we went from from 4 trillion to 9 trillion in the space of about 18 months. And this shows the reaction in the money supply. In 2008 to 2009, it looks like a minor blip. If you look at what happened here, and then if you look at what happened in response to the COVID pandemic, it was just completely, practically off the charts in terms of reaction compared to the global financial crisis. And so in about 250 years of U.S. history, it took about 250 years of U.S. History to get to $10 trillion. And then within 13 years, that tripled to $30 trillion. So this is a chart that I like, that really struck me. There are two things I find interesting about it. One is that the money velocity, which is how fast a dollar changes hands in the economy, bottomed twice in the 30s and in the late 40s, and we had stimulus to try and get that going, and it ultimately did get going again, and it crashed again recently because the economy was shut down in 2020. But what really stands out for me is that if you look at the left side of the chart, the bars are much closer together. Whoops, sorry about that. The bars are much closer together in this area. So this was when the Fed was much less active. And that's when you had recessions. Apparently a very bad thing are recessions. So when the Fed came in and really started getting active, these bars started to spread apart. Recessions were shorter and much farther apart because they thought, well, we need to fight recessions. They're awful. And yet they're a normal part of the business cycle. They're a cleansing of credit, and they're corrections. They were much more often prior to the Fed, and they were shorter, and life went on. Things corrected themselves naturally. And now all the Fed does is lower interest rates, print more money, and try to counteract it, but yet blows up bigger and bigger bubbles. And so with all of that, people, of course, are asking themselves, why are gold and silver struggling? Well, I certainly believe that's a temporary blip. Gold competes with the dollar. It's priced in the dollar. Gold competes with bonds, and bonds are yielding a lot better right now. Not great if you're if you bought your bonds a long time ago, but if you're buying them today, your yields are a lot better. And yet, national consumer, business, and student debts are are really unmanageable at much higher interest rates. And so the Fed knows that ultimately will have to back down. So why would you look at silver? As I say, silver is massively underpriced. If you look back far enough in history, silver is actually the first true international currency. We have the Greeks, the ancient Greeks, to thank for that, who fashioned the first silver coins. And ever since, it's been a fantastic inflation hedge. It's been used as money. It's been part of our money almost constantly since then, and only up until 60 years ago when it was finally removed from our coinage. And yet right now, silver is highly undervalued. It's the only major metal that is still below its 1980 high. You can look at all of the base metals, platinum group metals, gold, they're all well above their 1980 highs. The demand is rapidly outpacing supply, and we're expecting deficits for years ahead. Now, when I talk about how silver has protected inflation, I've gone back and looked at the price of silver in 1922. Well, it was 68 cents per ounce. And if you use the US's own CPI inflation calculator, silver should be $11 today. Well, it's actually trading at $22. So yes, you can argue that, and I would, that the US's inflation calculator is much too low. So at $22, it's doubled inflation, or official inflation, over 100 years. So in that measure, it certainly seems to have kept up with a reasonable rate of inflation over an entire century. If we look at mine supplies, that peaked in 2016. They started to fall off and took a relatively big hit in 2020 when mines were shut down. It fell for those 4 straight years. And then it's expected to start to increase. The input was out about 5% last year, but the forecast is for mine supply to peak again in 2024, just 2 years from now, and not necessarily peak any higher than its 2016 high. So if we look at what's been happening with demand versus supply, as I say, was up just under 5% last year, and yet demand was up over 19%. It's nearly a 5 times faster growth in demand in silver in just 2021 over supply growth. It's been up in all key sectors. Silver demand was up 19% overall in 2021 over 2020. Industrial demand was up 9%. Solar was up 13%. Electronics and electrical demand up 9%. And physical demand was up 36%. So people are really starting to clue in, are starting to buy silver as a hedge and for its upside. If you look at silver ETFs, they're near record highs. It's interesting to consider that the first silver ETF came to life in 2006. And in all that time, despite the extreme volatility sometimes in the silver price and large corrections, the overall holdings globally of silver ETFs has hardly ever dipped. It's grown, moved sideways, grown, continued to move sideways, and then grown and grown and grown. And today we're at 1.13 billion ounces of silver, which is more than an entire year's supply of silver, all held in silver ETFs. And solar in particular is something interesting to look at. It's the single largest use of silver. 54% of all silver consumed every year goes to industrial demand. And overall, all silver used, consumed or demanded every year, whether investment or industrial, solar is the single biggest use. It represents 11% of all silver requirements. The growth in silver demand was up 125% between 2013 and 2021. In 2021 alone, solar demand for silver grew 13%, and this year it's forecast to grow another 12%. And if you look at what the International Energy Agency is forecasting for solar output, solar capacity, just in the next 8 years, it's supposed to be up by 8.5 times. So if silver already consumes 11% of all of the silver supply annually, and the growth is supposed to be up 8.5 times, we're going to be at 969 million ounces of silver, all going to just solar demand, which naturally can't happen. At least it's going to be quite challenging, not a realistic scenario, and certainly very bullish for higher silver prices. And just an interesting dynamic on the silver price and the value of silver ore. So in 2005, silver was priced at around just north of $7, and by 2020 it was just north of $20. So that was a $185 increase in the price of silver. And yet silver ore grades dropped from 13 grams per ton to just just south of 6 grams per ton, so it dropped over 50%. So a ton of ore mined in 2005 compared to 2020. So 2020 value of a ton of ore is actually only 27% more valuable than it was 15 years earlier, whereas the silver price was up 185%. So that tells you that falling ore grades, despite higher silver prices, doesn't help silver miners to help mining silver that much more profitable. And as I say, silver, the deficits are expected to continue. There was a deficit last year. The Silver Institute forecasts a deficit in silver supply this year, and they expect silver deficits for several years ahead. Silver is cheap. It's still 50% below its nominal all-time high. It's 90% below its inflation-adjusted all-time high. And when it bottomed at $12 in 2020, when the COVID pandemic hit, it bottomed at $12, which was 3 times the low of 2001. So to me, at least, that says that if after that kind of an impact on the price, if it's going to bottom at 3 times its prior low of 2001, it's still well within its secular bull market. And this is one of my favorite charts. I compare the Dow, the S&P, gold, and silver in the 1970s. So at the very bottom, you've got actually 2 lines, a blue and a red line. You can hardly see them because they're both the Dow and the S&P together. And over that entire decade, the Dow and S&P were flat. And that's not even accounting for inflation. So there was basically no returns in these 2 indices for 10 years. In the meantime, gold was up 1,400% and silver was up 3,700%. So the big moves tend to come late, but you need to be there when they come because they can be certainly dramatic. And since 2000, there's a similar chart to the one I just showed you. I don't have it up now, but it compares the Dow, the S&P, silver, and gold since 2000. So if you were to ask the average person, where's the best place to have had your money over the last 20 or 22 years, almost invariably you'll hear stocks. And yet that's not the case because silver's been up nearly 400% since 2000, and gold's been up nearly 600% since the year 2000. And before the correction in stocks, the Dow and the S&P were up about 200% since 2000. So gold and silver have dramatically outperformed stocks since 2000. And as I say, I still believe we're well within that secular bull market. And if you look at the world silver price, so that's silver priced in some of the largest currencies worldwide, the most important currencies, that's the blue line. So priced in world currencies, silver is actually nicely above its level in US dollars. So on a worldwide basis, we're still in very much a silver bull market. We haven't taken out the 2011 highs, but we're getting there. Silver versus commodities, especially if you look at since the start of this year, commodities have taken off. They've certainly blasted higher since 2020. And if you had to compare the returns in commodities with what how silver has performed so far, silver would in fact need to double just to keep up with the broader commodities complex. So that certainly bodes for some interesting upside. Ultimately, I think the Fed will blink. It knows it should raise rates. It realizes it realistically cannot raise rates. Debts are just too high. Government debt servicing would become unaffordable. That's why I think we're leading towards modern monetary theory, where printing will be the norm. People will accept it as fine, and the ultimate solution. And even without raising rates and having much higher rates that the government would have to deal with in that kind of scenario, debts are just growing too quickly. Ultimately, that I believe is the final outcome. So the Fed will blink more than likely. I believe by the end of this year, the Fed will have to at least stop rate hikes and perhaps even start lowering rates, certainly when a recession or a bad enough stock market crash comes along. they'll be prodded that way. So I think that will be the start of the next great silver upleg. So if you don't own silver yet, my question is, what are you waiting for? Buffett actually bought silver twice in his investment history that we know of. It became too cheap in his mind. Supply was too low, too far below demand. And this was in 1966 after it was taken out of the coinage. And then again in 1996, he bought silver in a big way and ultimately made a cool $100 million profit on that investment. So people often ask, when will silver take off? Well, I tell them, if you look at where we were just a few years ago in 2018, 2019, silver was still plateauing at $15. Today at $22, we're up 40%. So silver has, in some ways, taken off. You need to be in the market to benefit from it. And as I say, if you want to participate in that upside, silver will ultimately do extremely well. So my question is, what are you waiting for? Are you waiting for the next crisis before silver explodes once again? These are all things that I detail, as I say, in the book. I've laid out the case for silver. I feel that's the best way to get the complete picture of the opportunity in silver. I go through the economics and the history and the fundamentals on silver, and I even talk about sentiment in the market, psychology, and your investment options, everything from physical silver all the way to explorers. I explain how to invest and how to ultimately sell, because silver will peak and you'll want to cash in. Where you put your money after that is up for debate, but you will want to cash in to benefit from it. And so I go through all of these things in the book. Again, as I say, it's available on Amazon. We're in the main hall here, and I have copies available. If anybody's interested, it's available for purchase. And if people buy it and read it, I would encourage you to post reviews on Amazon. And what I do is I write a newsletter called Silver Stock Investor that is actually, I guess, more of an ongoing, more real-time view of the silver market versus the book. And I encourage you to go to the site and follow what I do. And if you're interested, you can certainly subscribe there. So thank you very much.